Welcome back, everyone, to the next session of the Modern Investor Summit. I'm Sri Kochagovindan. I'm a senior economist at Aberdeen, and it's my pleasure to guide today's discussion on macro opportunities and trends shaping the next decade. Joining me is Christina Hooper, Chief Global Market Strategist at Invesco, whose insights on navigating complex market cycles are highly regarded. And together we'll be tackling some of the big questions facing investors as we look to the next decade. So how can we best prepare for the market cycles? What role will technology and long-term structural trends play in investment decisions? And what are the three priority areas to focus on in volatile markets for strong returns? Before that, some quick housekeeping notes. Feel free to introduce yourself in the chat with your name and where you're turning in from. We'll have about 15 minutes to discuss, and then that's followed by 15 minutes for Q&A. So don't hesitate to drop your questions in the Q&A box. So, and with all of that covered, let's dive in. Christina, thank you very much for joining. And to our first question, what do you consider to be the most important long-term trend for financial markets over the next decade?
Well, I don't know if it meets the criteria of over the next decade, but certainly for the next 5+ years is probably going to be the continuation of monetary policy normalization. What we've been through is really an extraordinary period of experimental monetary policy with the introduction of QT, with with the introduction of QE, with ultra low rates for quite a significant period of time. So unwinding that is going to take time as well. And that to me is certainly a really important trend. Also, I wouldn't have necessarily anticipated about 9-10 years ago, if you asked me this, about greater political instability, about deglobalization. I wouldn't expect it to be a long-term trend, but it seems to me that it has become a longer-term trend. That certainly has implications as well. Just the events in South Korea that we've seen remind us that political instability, that deglobalization issues, the discussion around tariffs and the potential for tariff wars all suggest this is a longer-term trend as well. So among the most important that I think are impacting financial markets. Beyond that, of course, the increasing use of alternatives. Investors are recognizing more and more the importance of diversification, the importance of alternate sources of returns, and we're seeing that manifested in increasing exposure to alternatives. And then just the trend towards greater self-reliance on essentially funding one's own retirement. There are many countries where up until a few decades ago, most workers relied on pensions to fund their retirements. They didn't worry about having to do it themselves. And now we're in very much a DIY world for many.
Thank you. So you've talked a bit about the politics as well as AI and diversification needs. Some of these trends, how do you think they're going to filter through into to impact in the markets? And how do you think they'll the evolution of asset prices from here, given these structural drivers?
So let's talk about monetary policy normalization. We're seeing very significant changes in asset prices as expectations change around the path of key policy rates. And so that's going to continue to happen. I think it's harder for markets to price in, for example, QT, but the reality is that we do have an asset reaction, particularly in the stock market, but also in the bond market, to what we're seeing in terms of expectations around different central banks. And that's likely to continue, I think, as it is more gradual, for example, for the Bank of Japan to increase rates, to normalize its policy. Asset pricing won't react as dramatically, but we're certainly seeing reactions to monetary policy normalization, and I think that will continue. When it comes to increasing use of alternatives, there seems to be enough in the way of cash out there that it's not necessarily impacting other asset class prices, but we're certainly seeing more and more money flowing into alternatives.
Thank you. And in terms of the kind of, I mean, I was just looking at your weekly market compass, which was out recently. In terms of how you look at the world, there are just obviously several different layers to the sort of data and analysis that you do, ranging from sentiment, valuation, positioning, and as you've just said, monetary policy. Could you talk us through some of your framework for, first of all, for the short term, how you would look at the next 6 to 12 months, for example?
Sure, Sri. First of all, I think it's important to recognize there are so many different inputs, and at times you can't help but weigh some more than others. But what we try to do is look very, very holistically. And so the very short term, 3 to 6 months, could very much be impacted by certain policies. I talked a little bit about geopolitical risks, deglobalization, the kind of political instability that we've seen in places recently, including conflicts. That certainly can impact the short term, and we have to recognize that that is a risk. But that is not how we form the basis of our base case scenario. What we're doing is looking at the trends. What does policy, and especially monetary policy, tell us? And to understand where central banks are going to go, we need to look at not just the very traditional measures around inflation, but we also need to look at sentiment. We need to look at things like the University of Michigan's consumer inflation expectations because the Fed cares about it. We need to look at inflation expectations in Europe because the ECB cares about it. We also need to look at business sentiment. That helps us understand, for example, predisposition to increasing investment, increasing hiring. Certainly, we anticipated this fall that we'd see a slowdown in hiring, in spending plans in the UK because of uncertainty around the autumn budget. Similarly, in the US, we anticipated that because of uncertainty around the US election. That tends to happen. It's again, a very short-term phenomenon, but it has an impact on the shorter term. But for us, it's about where are we in the economic cycle? And what policy is going to impact us over the next 6 to 10, 12 months based on some of the inputs I mentioned. So our expectation going forward, just to give an example, is that while we're seeing somewhat of a modest slowdown right now, we're likely to see a reacceleration next year. First and foremost in the US, but also other Western developed economies. That's likely to be driven by improvement in real wages. Disinflation continues, and so that means that all else being equal, spending power improves for workers, for households. Now, of course, that is dependent upon a continued relatively low unemployment rate. But what we've seen thus far is a normalizing, but still very good labor market in the US and in other economies, in other Western developed economies. We also see the potential for policy stimulus in China having a significant impact, not just on China, but having knock-on effects, for example, for Europe because of Chinese consumer spending. So that gives you a little insight into how we look at the world and what helps us form the basis of our outlook. That economic reacceleration would be driven not just by real wage growth, but by monetary policy. The expectation that central banks at different speeds will continue to lower rates. And that, of course, we're looking at a pretty big picture to anticipate what central banks are going to do. And we're also looking at a big picture in terms of anticipating what employers are going to do in terms of layoffs. We don't just look at surveys. We don't just look at the data. We also look at anecdotal information. So something like the Federal Reserve Beige Book provides some interesting insights. That was actually where we could glean over time the interesting phenomenon that employers were reluctant to cut employees. And they articulated in these surveys that they had had such difficulty getting employees that it was going to be very difficult to let them go. And they didn't want to have to retrain new employees when the economy got better. So they had decided to hold on to them even if the economy deteriorated. That was an interesting insight, and I think that has held. And that's why we continue to see a very good job picture in the face of some headwinds over the last year plus. So I think in general, it's about sourcing, finding data wherever we can, looking at less traditional as well, and really looking to anecdotal information to help fill in the picture on what's happening with the data.
It's quite an interesting thought point there in terms of employers being reluctant to lay off workers, considering the labour shortages that we'd experienced through the pandemic in particular. So that's a very interesting point there. But so those would be the sort of nearer term indicators. And in terms of the longer term trends, I know you look at long term capital market assumptions in order to set your portfolio weights. I mean, how do you go about looking at that? I mean, do you look at that? You mentioned earlier some of the longer term structural drivers. How do you put all of that together?
Well, we actually have a team in Invesco that puts together our capital market assumptions and does a fantastic job. And a lot of it is based on historical data, what we've seen in terms of history and expectations around reversions to the mean, just as well as other inputs in terms of longer term growth expectations. What we're looking to do is see where there is potential, particularly upside, but also downside potential. So, for example, an input like AI could have a significant impact and might make the picture a bit more rosy than otherwise expected. It's not something that's going to show up in capital market assumptions necessarily, but it's something that we certainly think could have a significant impact. I'll give an example. If we go back to the late 90s, what we saw was significant investment in technology and innovation, and that did have an impact on productivity, and a positive impact, of course. And our expectation is that could happen again, and that could be something of a game changer in terms of increasing GDP growth. I think there are a lot of parallels to the 1990s. So think of us also as a little bit of economic and financial historians. Not only, again, we're looking at history to help determine what our long-term expectations are for different asset class returns, but we're also looking to history to find parallels to other periods and say, for example, what period does this look most like? And I would argue that the 1990s seemed quite similar to the period we're in currently. That was the last time, for example, the Fed had a tightening cycle where the U.S. was able to avoid a recession. That's the last time we saw significant investment in technology, driven by the internet, driven by Y2K upgrades. But nonetheless, there was that investment there. It delivered higher productivity, and we saw very significant stock market gains. I think there were 4 calendar years where the S&P 500 had back-to-back really strong returns. So I think that's the kind of environment we've set ourselves up for. I think we could have multiple years where we get strong stock market returns. I think it's an environment where we're going to see higher productivity growth. Certainly, we have to worry about some short-term headwinds, tariffs, and restrictive immigration policy. But again, the starting point would really be those capital market assumptions, and then just some tweaks that we might see in terms of upside or downside risks. We also think in terms of swing factors, which are shorter-term factors, like immigration policy, that might also impact returns in the next 1 to 3 years.
Thank you. And just on that point, I mean, do you see, you talk about base case, do you see some risks? How do you look at scenarios? How do you incorporate some of the risks around these drivers?
So we come up with a base case, which we think is the most likely scenario, and we try to do that for the major markets, for major economies and markets, and we anticipate which asset classes are likely to perform well in this kind of environment based on history, and that is that is our broad base case. And then we have an upside scenario and a downside scenario. The upside scenario is if everything goes very well, if growth is higher than expected, if inflation is lower than expected, just given that central banks are playing such an outsized role right now in economic fortunes. And our upside case would mean a greater risk-on environment. So think of it as just our base case on steroids. And the downside scenario is one in which we see inflation harder to beat, where we see growth lower. That's an environment in which we don't get as much in the way of rate cuts. It's an environment in which we don't see much in the way of growth. And of course, it's a more risk-off environment. And so, we do that with every outlook. We do a mid-year and an annual outlook. So we just released our 2025 outlook. So we have those three scenarios in there. And then we also list swing factors that can impact the base case, arguably bringing us closer to one of the alternate scenarios. And this year is a big year because of all the policy uncertainty. One of the other trends I didn't discuss was, fiscal headwinds. There's so many governments right now, they're coming under pressure in terms of running large fiscal deficits. And of course, as a result, there can be bond vigilantism, at least the threat of bond vigilantes. And of course, there could be some significant headwinds as governments feel they need to embrace greater austerity. That can impact growth projections. So, just in the last few weeks, we've seen, one of the reasons the issues in South Korea is arguments over the budget. The UK budget, as I said, was a big issue. The US, we're talking a lot now about the budget. Could we have an even larger fiscal deficit? And the nomination of Scott Bessent, of course, calmed markets because he has that plan to have run fiscal deficits no higher than 3% of GDP. So there's clearly a lot of focus on that right now, and that can be, just one swing factor, to give an example, that could push us in one direction or the other. Ironically, that's one in which it could push us into slightly slower growth in the near term if we're cutting spending, but at the same time could be more positive for markets because the 10-year comes down. That tends to be a tailwind for stocks.
Yeah, it's true. There's a lot of moving parts there in terms of fiscal, monetary policy, migration, and trade, obviously. What advice would you give to retail investors in order for them to help protect their portfolios and maximize their returns? Because obviously the way we do things, and then what advice would you give them to what to focus on?
So my guess is that at least some retail investors are probably overexposed to large cap US equities, just based on performance over the last several years. If they're not regularly rebalancing, they're likely to be overweight. So it's the end of the year, and this is a perfect opportunity to take stock of one's portfolio and ask, am I overweight there, and should I be rebalancing? We certainly don't want to abandon US stocks, but there is an argument to be made for having more exposure to small and mid-cap US stocks. Again, our expectation is that we see an economic reacceleration next year. That's likely to benefit those asset classes that are more sensitive to the economic cycle. Small caps, mid caps, cyclicals. So having greater exposure there, not only is it prudent to rebalance, but it could be a good time to do it, just given our expectations on the economic outlook. And of course, I also would expect that there are at least some clients who are underexposed to equities outside the US. And I think there are some attractive opportunities in Europe. European equities and UK equities in particular, high dividend yields, far lower valuations than the US. Now, are the economies there firing on all cylinders? No, but you don't need strong economies to have strong market performance. In fact, quite often you can get it when there's significant negative sentiment around an economy, and there's positive surprise. Also, individual stock selection can help. So an actively managed portfolio, I think this is a good time to be actively managed, at least in some areas of the market. Emerging markets equities are certainly experiencing some headwinds right now, but I think there's potential there. And historically, what we've seen is that when the Fed eases, that tends to be a positive time for emerging markets equities. Also, don't ignore fixed income opportunities, high yield, investment grade credit. The economy, the U.S. economy and other economies have held up really well. I think resilient is the best way to describe them. And that's a supportive, that has historically been a supportive environment for credit and for high yield, especially high quality high yield. I feel good about right now. So I just can't say enough about the opportunities in all the major asset classes. And again, this speaks to the importance of diversification. It's hard to preach about diversification, especially when we've seen a strong year for equities. But now more than ever, it's important for investors to recognize the need to have lower correlating asset classes, and also, of course, exposure that's diversified geographically, in terms of capitalization, in terms of valuation, even.
That's great. Thank you. I'm just seeing that there are lots of questions coming in through from on our chat. So I'll start just link into what you said about emerging markets. There is a question here that asks about emerging markets, but specifically, what metrics do you look at? How do they pick within emerging markets?
Well, that's a great question. You have to be very, very cognizant of historical valuations when you're looking at emerging markets. You could look at the Indian stock market and say, gosh, it's highly, highly valued. But in fact, historically, it has been highly valued. And what you're paying for is just an incredible demographic picture. A lot of entrepreneurialism. There's a lot of reasons why the Indian stock market is richly valued. So I think it's important to just have that context, to have that historical perspective. But I certainly do comparative valuations as well. And looking, for example, at the UK stock market, the PE ratio is wildly different than the PE ratio for the S&P 500. And so I think that makes the case for having some exposure there, recognizing a very, very different set of measures, very, very different metrics for the UK stock market. But on the plus column, we have higher dividend yields. As I said, we have much lower valuations, and I think that makes the case for being diversified there, just as an example. But in the EM space, you also want to look at regions, and I would argue that for EM equities and EM fixed income, it's important to think in terms of different regions and not to have a one-size-fits-all exposure to emerging markets. I think China is a large enough economy and market that it shouldn't be lumped in with the rest of emerging markets. It should be, for example, a standalone asset class within one's portfolio. And I think it makes sense to also break out emerging markets in Asia from emerging markets in Europe, from emerging markets in Latin America. Within regions, there are certainly some similar characteristics, but they're not necessarily a lot of similarities across emerging markets. So to get more specialized and have different exposures, I think makes a lot of sense in this environment. For a variety of reasons, because there are a lot of macro factors that are impacting emerging markets equities, and that's going to have a significant impact. So I'll leave it there, but I could ramble on, EM, but
yeah, it's such a diverse mix of regions, assets, equities, and so on. There are some questions here on around a couple of questions I think we should come to would be, first of all, the future of Europe. I know there's a lot of political dynamics there, particularly France and Germany, engines of Europe. How do you see the future for European industries? What's going to drive growth there?
That's a great question. And Mario Draghi released a report a couple of months ago on this topic, on the importance of Europe becoming more competitive. I think what we're seeing in terms of the headwinds for manufacturing in Germany, for example, is part of a more global phenomenon that really is a result of the pandemic. Because if you think about it, we went through a period during the lockdown where it was goods purchases, not services purchases, because economies weren't very open. People were sheltering in place. But once economies reopened, we saw there was very little in the way of goods purchases relative to services purchases. And you could see it in the PMIs, in the individual country PMIs. It's very normal to see many Western developed economies where manufacturing PMIs are in contraction territory and services PMIs are in expansion territory. It's just unfortunately that Germany relies on manufacturing as opposed to services. Interestingly, some of the peripheral countries in Europe, for example, Italy and Greece, they've been doing much better. But that's because they're more driven by a services economy as opposed to a manufacturing economy. So I think that as economies normalize over time, we will see improvement in manufacturing. Again, we're still in that post-pandemic period where things are still out of whack to a certain extent. And it's going to take time to get back to an environment in which we're going to see greater goods purchases, where we're going to see manufacturing come back. That's going to be a problem in the near term. And that's an argument for being part of the European Union because there is diversification there and some economies are doing better than others right now. And Germany, which had historically been the anchor for the EU, just isn't as much today. But I think there are real competitive issues, especially as we see changes afoot. For example, electric vehicles and the ability to produce electric vehicles at much lower prices, which is a very competitive, which is a very, very significant threat to Germany. So I think that we're going to certainly see some right sizing there. I think that innovation, investment in technology could be could have a very positive impact on manufacturing in Germany. I think when we think about AI right now, we think about a few tech companies, and the reality is the beneficiaries are not necessarily in tech. It could very well be that the manufacturers are some of the biggest beneficiaries. So I'm very optimistic. I think this is more of a shorter term headwind, but a significant one nonetheless.
Yes, absolutely. And I think we've got time for one last question. What asset classes do you believe will benefit from AI, green energy, the green technology investments? Because you were talking about investments just then. Do you think there are particular beneficiaries and asset classes as well?
That's a great question, and I haven't really thought that much about it, but I can certainly come back with an answer for that. I just been focused a lot more on AI than green tech as of late.
Yeah, thank you. And also just one more thought then in terms of these big drivers. AI can have a disinflationary trend over time, but then we have these geopolitical shifts. What do you see in terms of the longer run trends? They sort of offset each other. What do you see for inflation?
So I think definitely AI is a disinflationary trend. The biggest issue that probably AI raises in the medium term is one around the potential for greater geopolitical instability because of job loss. I mean, let's face it. I mean, if we go back to the Industrial Revolution, Luddites were preventing the delivery of farm equipment because they knew it meant, or at least they had a sense that it meant there would be higher unemployment for farm workers. Now, the reality is that tends to be just a a transitional problem, and that ultimately more jobs were created as a result of technological innovation. But it's that interim period that can feel long, especially in a worker's life, that can be really problematic. And that's why I think we've seen some efforts and some experiments around basic income, and we're likely to see significantly more. But for me, that is the trend that is overwhelmingly positive, but we have to recognize there are some really significant areas of downside to AI. Of course, there's that political dimension in terms of misleading information and perhaps altering election outcomes as a result of what could be erroneous information being shared and through the use of AI and technology in general. But to me, the advantages greatly outweigh them, and it's not just disinflation; it's productivity growth. And actually, if you think about it, productivity growth is one way we can see GDP go up significantly. Growth, there's the potential for growth levels to get significantly higher with enough investment.
Oh, thank you so much. I mean, we could talk. Well, unfortunately, we're out of time, but thank you so much for joining us and for all the insightful discussions. Thank you, Christina Hooper. Really appreciate your expertise and the strategies for navigating an evolving landscape for investments. So stay tuned for our next session. It's be featuring social scientist and author Dan Ariely, and we'll be back in 15 minutes. And so see you at the next session. Thank you.